So good morning, everyone. It's good to be here with you. So my name is Matthew Rossett. I'm technology M&A banker. Have been for the past 17 years. I'm a managing director at Lincoln International, and that I joined 5 years ago, and I co-head the technology practice in Europe. So to go to the next slides, is it something I can manage, or is it this one? Okay. So for those who don't know Lincoln, just a few words. We were founded 26 years ago in the US, in Chicago. We've been growing above 20% every year for the past 26 years. We are now about 900 bankers overall. The tech practice is made of 120 bankers. When I joined 5 years ago, it was 10, so it's been pretty strong growth, and we are very active with PE firms. We're actually according to Merger Market, the leading M&A firm on the sales side for PE exits globally in 2022. The tech practice, as I say, was started in 2015. When I joined 2017, 10 people, not 120. We do around 90 transactions, a lot in software, more than 50 every year. And so we just about, over the past 3 years, have done 130 transactions, which interestingly starts to make a lot of data to play with. And so we will share some of the insights of, all this data in the following slides. So the current market environment, nothing new for most of you. Some uncertainty, inflation, increase in interest rates, a softening on the market, especially a strong public market correction. What we see on the private market is that there has been a correction, but pretty much softer. And for the quality assets, actually no correction at all. There is still a lot of capital to be deployed, and funds continuing to raise. And but probably the word that describes better the current environment is selectivity. People are much more selective and fly to quality. And in the software market, let's say people talk a lot about the Rule of 40. Is anyone not aware of what Rule of 40 is in the software market? That's okay. So, well, it's a combination of growth and profitability, basically. And so today, people, the focus is probably more on profitability than on the just the pure growth, and that's what we see today. So overall, B2B software, I think, is interestingly, longer term, category that continues to be extremely attractive for three main reasons. The demand drivers for software solutions, continue to be there. Strong digitization of the economy, automation of tasks, also the massive increase of data volumes that makes the use of software absolutely necessary for companies that needs to focus on their core business. The business model is pretty sound, especially SaaS business model. Gives you high revenue visibility. I think what we call at Lincoln the power of cohorts and data, which in our view makes B2B software these days almost considered as a specific category like infrastructure a few years ago. And interesting, we start to see infrastructure funds launching dedicated technology funds because they see the kind of same data sets and cohorts that are in infrastructure. And the third point is that this is also a category where we start to see also specific financing, and we actually have a dedicated team at Lincoln that is pretty active, and where as people understand better and better the business models. You know, the financing is not only based on EBITDA, as we generally see that, you know, for the other sectors, but we start to see, you know, AR-based financing, especially with dominant unit trust solutions in Europe, and that makes a very good environment for software to thrive in terms of, you know, M&A market and investment opportunity. And interestingly, you know, between 2015 and 2022, you know, the market grew by 50%, but actually, you know, the deals with PE firms grew by 130%, and now, you know, PE firms represent 30% of the total M&A transactions. In Europe, if we focus on the market, what we see, you know, as is also, you know, driver for active environments is what we've seen the past 5 years is a lot of new funds being created, for sure, and especially with US firm coming to Europe. So they have, you know, it's just illustrative. It's not exhaustive, but, you know, people like Thoma Bravo just arrived, like Great Hill as well, Marlin a few years ago. We have also, you know, funds opening, you know, starting, you know, generally start with London and then start to open local offices. So, you know, AG here, you know, open offices recently in France, same for PG, Summit, Turn River. We have new funds that specifically dedicate on just B2B software in Europe, like Carlton Capital, GTO, and let's say the big, more generous funds now, you know, also, you know, start to be quite specialized and have dedicated teams to cover software. Another trend that we've seen the past few months is that the public market, because, you know, of the strong correction that we've seen, offer a very happy hunting ground for private tech investors. So this is just an illustration of deals that happened in 22 in Europe. And for example, that was, you know, in Israel, but we advised Sun River on, you know, the tech private of Tufin, which is a cybersecurity company. So I was talking about, you know, financing and specific, you know, IR financing for especially software market. Not only it's also true for you know, some other markets. And so as you can see in the chart, between 2019 and 22, the share of recurring revenue financing has grown from 6% to over 20%. So it's real alternative for software company and give a lot of flexibility on how to drive their growth. With dedicated funds and also, you know, some illustration of, you know, companies like Kepler, Matrix 42, Paperfly that we advise that raise, you know, some error financing. Another trend is the fact that a lot of companies backed by PEs are strong consolidation platforms, and it's true for many verticals. Let's say there are the traditional software verticals like ERP and finance, and like especially companies like Visma, Access in the UK, Cegid, that are absolutely extremely active. Visma, I think it's, Martina, 50 transactions per year. Yeah, it's as active as Lincoln. So HR, you know, P&I, Smooth for the staffing industry, compliance, you know, people like Fortius in the UK and blah, blah, blah. So it's true, you know, for, you know, different verticals. Just recently we sold a company called Actito, a Belgian company, to Quantum, a Nordic company backed by Altor that wants to create a true alternative to Adobe, Salesforce in Europe. And the company in only 2 years went from 0 to 80 million of AR, just by consolidating the market. Award and valuation, it's always, you know, a topic that is of interest to people. So as we can see, there's clearly, there was trends, of growing valuations between 2016 and 2019. Then COVID arrived, and we had really, I think, some exceptional years with an increase of valuation for public companies that was probably a bit too high, on average, around 10 times. And now, it's back to kind of a, historical revenue multiple of 4.5 times. But as you can see, for the private market, the correction happened, I think, essentially because 2021 was an exceptional year, but we are still at very solid multiple at more than 7 times the revenues on average. And one of the reasons is that the market is more selective, so deals that happen on more qualitative assets, where we don't really see no change in terms of valuation multiples. And another trend is when you look at especially public companies, and looking back before COVID, profitable and non-profitable companies were valued relatively the same. And then, there has been a premium for growth. So there has been, between 2019 and 2021, a clear overperformance of non-profitable software companies, high growth, versus the more profitable companies. And since the beginning of 2022, there has been a rebalancing and clear overperformance of profitable companies. And we expect that to continue in 2023. And between US and Europe, no real difference. So, and the latest slides that I think is probably interesting to share with you is about what drives the software valuation. So I was talking about the Rule of 40. Basically, it's the strong correlation that we see between the revenue multiple and the combination of revenue growth and EBITDA margin. So 2 samples. One is the listed B2B software companies on the right-hand side. On the left-hand side is our own data sets on the transaction we've done over the past 3 years. Interestingly, the valuation is actually stronger on our own data sets, which is just based on the fact that the listed market have corrected. But it's still main driver for valuing a B2B software company today. So my presentation is finished. We can start the panel. Thank you all for your attention. So maybe we can check if it works.
Hello.
Yep.
Hello. Hello, everyone. Yep.
Hello.
So we have a very good and interesting panel. So we have Martina Sano, who's partner and head of private capital market for AG Capital. She has quite a unique perspective on the fundraising market, and especially how's the market today, and the perspective of LPs. So maybe Martina, it would be interesting to share some of your insights and experience on this, and how you see 2023 in terms of fundraising activity.
Thank you. Very happy to. Yeah, I think we all started seeing a change probably mid last year. For many funds, fundraising became tougher back end of 22. Looking into now 23, my view is that things are going to be tough out there. That said, the really best performing managers, they are going to continue to raise money, so that's no doubt. But I expect lead times to be longer. Fundraisings are going to take longer than they did over the last sort of 3-4 years. I do also think LPs, and that's what we hear, and our LPs are telling us, are generally taking a bit of a sort of sit back at the moment, trying to figure out what's happening in markets. And what bets essentially will they do in these times. So I think decision-making process from LP perspective is going to take a little bit longer. Of course, we also saw less cash back last year generally. That might also impact allocations. If you then look at where do LPs commit over the next 12 months, of course, we don't have the answer to that, but I do strongly believe that sector-focused private equity funds are going to continue to raise money. There's definitely some advantages on being specialized. And if you look at what HG is doing, we're essentially a B2B software buyout investor, and we invest behind companies that have very specific business models. So highly recurring revenue. They provide very mission-critical software service. Many of the logos that were on your slide earlier. But essentially, we back companies that provide accounting software, HR and payroll software, those kind of, that software that is really there to improve workflows, to automate the operations for the end client. And they are really mission critical. So in these times when things are more uncertain, that's not what you cut on. You might cut on other spend, but and that gives a really nice, resilient business model. And those are the type of businesses we back. And that's something that is resonating very well with our LP base, because what it also does is you have less volatility in the returns over cycles. We have specialized for the past 15, 20 years. So through global financial crisis, COVID, etc., the portfolio was still growing. And I think having essentially a very big team, we have 200 people only focusing on software investment, on value creation for our portfolio companies, essentially waking up every day just doing that gives you an advantage in today's market, because you know exactly what you're diligencing, what type of business models you're looking at. So those are some of my observations.
Thanks, Martina. So Pierre, as a founding partner of Isaïe Technology Buyout Funds, you're a pretty active investor both in France and Europe. As such, you have quite a unique perspective on the M&A market for technology companies. So after 2 hectic years, 2021, 2022, we start to see a slowdown over the past few months on the M&A market. So what's your take on 2023? Will selectivity be important? Valuations?
Yeah, good morning, everybody. So clearly 2023 is still, very unclear to me, and I think it's very unclear to a lot of people, so I don't have the magic answer to are we still going to continue to make tech buyouts and software buyouts, because nobody knows. And, tech buyout can be considered, or software buyout can be considered as a very, very niche market, but actually, I've been doing that for the last 22 years, and I can tell you it's very, very diverse set of things and deals and type of companies. So it's far more complex than just, software buyout. And there are some very diverging trends in the software buyout business at the moment. Of course, everybody loves software, right? It's recurring. This is quite profitable. You can control your growth, so that's very, very good. And some of the people who have not investing in the technology business before, they went to the tech market and say, we're going to do software because that's recurring and that's very good. But actually, the software market is not immune to some of the macro trends that are happening on the market right now, right? Salary inflation is a big, big thing, right? Pressure on gross margin is very strong. Lead time, when you are a B2B software business, lead time with your end customers, even if you are mission critical, they are much longer than what it used to be. I can tell you that the shape of the pipelines of our software company, and we've got about 50 of them in our portfolio, is very, very different from what it used to be 2 years ago. So there is uncertainty, how growth is going to look like, what's going to be the cost of growth is something. The cost of utilities, the cost of hosting is also changing things, right? This has significant impact on EBITDA margins, right? So overall, we shall not believe that software is immune to certain macro trends. So that's not playing for software. The The second comment maybe I'd like to make is, of course, that there needs to be some sort of settlement about what's the price for software, right? There is a big disconnect here in the sense that lots of generalist funds have come to the tech market by investing into software for the last 2 years. They've been resisting to invest in the tech sector for years and years and years, and unfortunately they came at the worst time, right? They've been paying the craziest price ever in the software market over the last 2 years. And of course, that's a problem, because if you look at the price of the private market for software, that's one of the biggest disconnect that I've seen over the last 20 years compared to the public market. So how do we reconnect that? At some point, there needs to be a reconnection, and there is some sort of food chain, right? We start with the lower market and which goes into the large cap guys, more like AG. And at some point, that disconnect cannot hold for years and years and years at the level of the disconnect that we see now, right? It's a huge disconnect. And the third trend maybe I'd like to mention is of course, when you are in the buyout business, our business, unfortunately, when you're a fund, is to be investing, right? That's what we do. So we have to be optimistic. So I would never say that I'm pessimistic about buyout investing, because I live out of it. So you have to be optimistic. You have to be making some investments. And of course, when you look at the overall market, if you're a generalist fund, do you want to invest in logistics? Do you want to invest in businesses which are impacted by FX? Do you want to invest in businesses which are impacted by semiconductor shortage and those kind of things? And of course, software, most of software businesses do not have those drawbacks. And of course, this will drive more dry powder, more money into the software business. But what remains, in my view, is to make sure that there is some reconnection about the valuation that have been paid and the new, let's say, the new world of valuation. And for me, this is still very unclear. And frankly, it's too early in the 2023 market to really see what's happening. So, we'll see in 6 months, maybe we know a bit more, but it's a bit too early for me.
Thanks, Pierre. Etienne. So you are managing director at EY Partner, strategy consulting firm, where you had the telecom and technology practice for Western Europe. And as such, you have quite a good perspective on the technology and software market trends. And probably it's interesting to have some of your insights here and your view for 2023.
Yeah, thank you, Mathieu. So, like you said, as a strategy consultant, I wanted to share with you some elements on the underlying market, because I'm way less introduction than you, than Pierre or Martina. But just share with you some takeaways we got from an event we organize every year, which is named the Top 250 Software Vendors event, and which is the opportunity to talk to all these vendors of software and to get their feedback on how they feel, and just to see if they feel as cautious as what Pierre was mentioning. So the good news first is that they had, again, I'm talking about the top 250 software vendors in France. They have been through a very interesting period of growth from 2019 up to 2022. In France, just so you have a few numbers, software business represents 20 billion euros business. And it was 16 billion in 2019. So you can see that, they have been through the COVID, they have been through the Ukraine war in a very smooth way, and they keep growing. And they do expect to face the same level of growth for 2023, so roughly 10%, maybe a bit below, it might be single digit, but more high single digit this year. And why do they think that way? Is because they believe that they have been through a massive transformation for them, which is the move to SaaS business. In the number showed by Mathieu, you are talking a lot about SaaS business, but an interesting number coming out of our study is that the software vendors in France are generating only 45% of their revenues through SaaS subscriptions, meaning that they still have 55% of their customer base to migrate. So we know that it's always a tricky moment. We were talking about that with Pierre before the meeting. It's a challenge to fit that, but 80% of their sales is done on SaaS product, on SaaS model. So you see that, the migrations to SaaS is underway now. We are going to pass the half of the market now will be using SaaS product, but it's still underway, and they see that as a good way to increase profitability, to increase recurrence, to increase resilience, as opposed to the perpetual license model, which was the norm until recently. So very positive, but bear in mind that it's just 45%. It's not 80 or 90% as we could think. Another interesting number. You say that there are many very successful software vendors who have a very verticalized approach on the market. And we can see that it's especially in France, by the way. Out of the 20 billion euros of revenue that I was mentioning of the market, 12 billion, so roughly 60%, is generated by vertical software vendors. And that's really something where at least the French vendor, it's more, I mean, in the US, typically it's more like 40%. So for some reason in France, the software vendors have a very verticalized approach and apparently very successful. And the last specificity, I would say, of the French market, we talk a lot about software, but in that software business, we do include what we call the digital platform players. And we have seen that for some reason, we have plenty of super successful digital platforms in France. And if you have a look at the largest fundraising happened over 21 and 22, they all come from not pure software players, but digital players, people like Sorare, Voodoo, Miracle, Doctolib, and so on, showing that we do have an expertise in that space. We believe that these are great business models because they are very scalable, and we'll talk maybe a bit later on what the investors are looking for. One of the keywords is scalability. And so typically, these kind of digital platform players tend to be very scalable, and they tend to be quite successful internationally.
Mathieu, would you allow me to make one comment?
Of course.
Just to give a sense of the granularity of that market, just to make sure we're not talking about one big thing, about that number you gave about SaaS. Just to make sure, SaaS means two different things. I think 80% of the room would think it means one thing, but it means two things. SaaS is a business model. The fact that you're not selling one-off on-prem licenses versus you're selling a recurring service that you're selling to your customer, and you're pricing on a yearly basis, on a quarterly basis, whatever. And it also means what is the technical stack that you have on the ground and how you maintain this technical stack. And I'm ready to bet that your number of the 45% is clearly not SaaS, right? This is a recurring way of billing your customer. But I think my view of the software business, of the software vendors in France, is that there is still a significant march towards SaaSization of their technical platform, which is a completely different thing versus selling on a recurring basis. So I think the ground to progression for the software vendors in France is very, very large, and this has huge implication in terms of capital intensity to execute that, in terms of cost of growth. So all of that is very major in the way you look at the software market in France in particular. So
I totally agree, and just to answer in anticipation with your second question, Mathieu, is what our clients are asking us when they consider investing in a software business. The first question is, where are they in this migration to SaaS? And from a financial point of view, but more than that, on a technical point of view. Because to put on the market a SaaS product means generally to rewrite entirely the product in order to make it cloud compatible. And it requires, like you said, a lot of CapEx, a lot of R&D, and a lot of development. And so that's one of the key things that investors want to understand when they invest in a software business is, okay, they say that they have a SaaS product. Is that true? Is it a commercial approach, or is it a real technical product that they have, and have they already started to sell it, and is the product successful after this migration to the cloud?
Yeah, and just a point on this, probably, as you mentioned, Pierre, a lot of people are coming to software because they are attracted by, the very efficient metrics. But as you say on this point, especially, not everyone, I think, is really capable of assessing, where the company is in this software transition. And here, we come to the point of, being really specialized and focused. And when you've come to, that software transition on one investment and on second investment, then, progressively you develop very strong experience, helping this company through transition. And we've seen, that the approach between specialized funds and more generous funds on this aspect especially is pretty different. And the capacity, to help companies, on this is also, pretty different. Martina, maybe it's interesting to share with us, your, how AG, in this current environment, is looking at, its investment strategy. Is it like you're still looking for a new platform to invest in, or are you looking to invest more in your current platforms, through a more active, buy and build strategy?
Yeah, absolutely. And I think coming back to also Pierre's earlier point, we still don't know what 23 is going to give us. What we have seen is that in the sort of subsegments of tech where we invest, valuation multiples have come down to kind of back to 2018 levels. So kind of roughly back to 10-year averages. But again, depending on what's happening to inflation, interest rates, we'll see if it stays there or whether that is going to go down further. We are in the business of investing, so we continue to invest and to make platform investments. All of that said, the bar is naturally super high for any new platform investments. We're being very, very selective. We typically, in this environment, back the type of or the businesses we have been backing and tracking and got to know over many, many years, and where we have very high conviction. So yes is the answer to that. When it comes to bolt-on M&A, that's part of our investment strategy, and that's not changing. We probably, if you look at growth across our portfolio, 1/3 at least is coming from add-on M&A, so inorganic growth. And at the moment, we have quite a long pipeline of add-on acquisitions. So I think today you can definitely find some accretive M&A to add to your portfolio, but that's kind of business as usual for us. The one thing that LPs are telling us is, look, investment cycles have been naturally faster over the past few vintages. Now, please take your time. We're actually happy if investment cycles are a bit longer, so sort of back towards the more kind of 3.5, 4 years to invest a fund. And that's something that we believe firmly in as well. And I think, it's aligned with having a more cautious and kind of higher bar to new investments. So, continue on that road.
Thanks, Martina. Pierre, on your exits or when you invest in companies, do you see the strategic route for your exits or strategic acquirers being more competitive versus private equity investors? It's a trend that we at Lycon start to see, but is it something that also you experience?
Well, actually, we see 3 buckets of potential buyers for our assets, and I'd like to remind that we play in the small cap, lower mid cap segment. So, of course, there is a lot of money on top of us. So, the assessment that Martina may make may be very different from mine. But as far as we're concerned, we see 3 buckets of potential buyers: buyout funds as a secondary or tertiary buyout, PE-backed platforms, right? And there are more and more of them on the European market in particular, and trade. So as far as we're concerned, making, mostly primary transaction, we expect that primary buyers are going to remain the bulk of our exits, irrespective of the market environment, because, we have profitable assets that are growing very fast, which have been tuned so that they can become buyout potential. So this remains very attractive, and frankly, we're not going to rush for exit in 2023 if the conditions are not good, so we don't really care. PE-backed platform that remains very attractive because it combines the best side of both things. There are some synergies, so that's very good, and there is the agility of the PE sponsor behind, which means that you don't have the lag that you typically see in a buyout versus a trade buyer, because clearly, fundamentally, irrespective of the synergies, trade buyer cannot compete with buyout players on an exit. That's just impossible. 80% of our exits over the last 10 years have been secondary buyout and not trade buyers. But still, yes, we see trade more coming back, you know, and I think you should be the one answering, because when we talk to your peers, it's very good that the trade buyers are back. You know, they are feeding the bankers more than the buyout firms over the last 2 years. So I think, yes, they are back. But as far as we're concerned, we don't really expect a big change, again, because we are a small cap player. So secondary buyout is the best option, still the best option.
Etienne, one last comment before we move to Q&A on your side.
Yeah, no, like I was saying, I mean, when we support investors in looking at investment opportunities in software business, what they ask are 3 things. First, where are they in the SaaS transition, like I said? Second, is the product, that's very related to what Pierre was saying, is the product really scalable? And when I talk about scalability, it's not only because it's a big word in the software business, but it's really to say, is the product from a technical point of view open enough to go international or to be interfaced or integrated with future acquisitions? And the last point is this company or product a good base for build-up strategy? And I can tell you that I have in mind a couple of processes which failed because the companies were more seen as a combination of different products than a real integrated platform. And it's always, we tend to always underestimate not only the cost to rewrite the product to go to SaaS, but also the cost that an integration of 2 or 3 or different solutions will be. And that's the main thing that they're looking at. One thing also, there is at the moment in Europe a great shortage of talent and resources, and that will be something that we'll have to look at in the coming years. It may be one of the biggest barriers for growth in the software business. So we're looking at nearshore, offshore solutions, but it's a big problem at the moment.
Thanks, Etienne. Martina, Pierre, thanks. I'm looking at IP, guys. Do we have like 2-3 minutes for Q&A, or are we good? No. Okay. Thanks, everyone.
Thank you.
We can take Q&A, outside.